The benefits and drawbacks of business loans. Title: The benefits and drawbacks of business loans. Introduction. Business loans play a crucial role in the growth and success of companies worldwide. Access to capital is often a primary concern for businesses, especially during their early stages or expansion plan. NS. However, it is essential for entrepreneurs and business owners to understand the benefits and drawbacks associated with business loans before embarking on this financial venture. This article aims to explore the advantages and disadvantages that come with business loans, providing valuable insights for decision-making in the pursuit of funding. Benefits of business loans. 1. Access to capital. One of the primary advantages of business loans is that they provide immediate access to capital. Whether used to start a new venture, fund day-to-day operations, expand an exes ting business, or make essential investments, loans offer a quick solution for obtaining the necessary funds. This access to capital empowers entrepreneurs to seize opportunities and fuel growth, giving their businesses a competitive advantage. 2. Business expansion. Loans are often utilized to finance expansion plans, whether it involves opening new locations, developing new products or services, or scaling operations. Business loans provide the financial resources required to take ambitious steps forward, allowing entrepreneurs to capitalize on market opportunities and increase their market share. 3. Flexibility. Business loans offer flexibility regarding how the funds can be used. Unlike certain types of funding that dictate specific spending parameters, loans grant the borrower freedom to allocate funds based on their specific business needs. 4. Economic advantage. Another significant benefit of business loans lies in their potential to stimulate economic growth. When businesses secure loans, they inject funds into the economy, creating employment opportunities and driving overall economic activity. Small businesses, in particular, contribute significantly to job creation, making business loans an essential catalyst for economic progress. 5. Credit building. Responsible borrowing and timely loan repayments can improve a business's credit profile. Successfully managing loans and meeting repayment obligations demonstrates financial stability and responsibility to lenders and credit agencies. Building a good credit history opens doors to better loan terms in the future, allowing businesses to secure larger loan amounts or lower interest rates. Drawbacks of business loans. 1. Debt and repayment obligations. Business loans involve taking on debt, which means the borrower is obligated to repay the borrowed amount along with any interest within the agreed time frame. The burden of repayment can impact cash flow and tie up resources that could have been used for other business purposes. Entrepreneurs need to carefully consider their ability to meet repayment obligation before taking on a loan. 2. Interest rates and fees. Interest rates and fees can significantly impact the overall cost of a loan. Higher interest rates or excessive fees can make borrowing more expensive, adding to the financial burden on the business. Before committing to a loan, it is important to consider the terms and conditions, ensuring that the interest rates and fees are reasonable and manageable. 3. Collateral and personal guarantees. Many business loans require collateral or personal guarantees, especially for small businesses or startups. Providing collateral puts business assets at risk in the event of loan default. Personal guarantees, on the other hand, can jeopardize the entrepreneur's personal finances. It is essential to assess the level of risk associated with these requirements before accepting a loan. 4. Impact on credit score. Defaulting on loan repayments or struggling to meet the agreed upon terms can have adverse effects on the business's credit score. A low credit score can make it more challenging to secure future loans or obtain favorable rates. It is vital to carefully plan loan repayments and ensure sufficient cash flow to meet the obligations. 5. Financial discipline and constraints. Business loans introduce an additional layer of financial discipline. Entrepreneurs must plan their finances meticulously to ensure loan repayments are met promptly. The commitment to repay the loan may also affect the business's ability to take on additional debt or enter into new financial agreements, which could restrict growth opportunities. 6. Documentation and approval process. Applying for a business loan involves a significant amount of paperwork and documentation. Lenders require financial statements, business plans, and other supporting documents to assess the borrower's creditworthiness. This process can be time-consuming and may require the assistance of professionals, adding to the overall cost and effort involved in obtaining a loan. 7. Limited control. Business loans are typically provided by lenders who have a vested interest in the borrower's financial affairs. This relationship can mean limited control over certain business decisions. Lenders may impose restrictions on how the borrowed funds are used or require regular financial reporting and monitoring. Entrepreneurs should consider the potential loss of autonomy when entering into a loan agreement. 8. Risk of loan denial. Not all loan applications are approved. Lenders evaluate various factors, such as credit history, business performance, and industry risk, when deciding whether to approve a loan. The risk of loan denial is a drawback that entrepreneurs must be prepared for, as it can limit their ability to access the capital they need for their business ventures. 9. Dependency on external funding. Taking on a business loan means relying on external funding sources for capital. This dependence on loans can make a business vulnerable to economic downturns or change in the lending market. Entrepreneurs should carefully consider their long-term financial strategy and explore alternative funding options to reduce their reliance on loans. 10. Emotional stress. Managing debt and loan repayments can cause emotional stress for business owners. The pressure to meet repayment obligations and the fear of defaulting on loans can take a toll on the entrepreneur's mental well-being. It is important for business owners to prioritize their mental health and seek support when needed to navigate the challenges associated with business loans. 11. Market volatility. Business loans can be affected by market volatility, especially if the interest rates are variable. Changes in the market can lead to fluctuations in interest rates, making loan and repayment more challenging for businesses. Entrepreneurs should consider the potential impact of market volatility on their ability to meet loan obligations and factor this into their financial planning. 12. Time constraint. Applying for and obtaining a business loan can be a time-consuming process. From gathering the necessary documentation to going through the approval process, it can take weeks or even months to secure a loan. This time constraint can be a drawback for businesses that require immediate funding for time-sensitive opportunities or emergencies. 13. Impact on ownership. Depending on the type of business loan, it may require the borrower to provide the lender with an ownership stake in the company. This arrangement can result in a loss of control or decision-making power for the entrepreneur. It is crucial to carefully review the terms and conditions of the loan to understand any potential impact on ownership or equity before proceeding. 14. Additional financial burden. Loans come with repayment obligations, including interest payments, which can add to the financial burden of a business. 15. Risk of default. No business venture is entirely risk-free, and there is always the possibility of unexpected challenges or setbacks. If a business faces difficulties and cannot meet its loan rep payment obligations, it could lead to default. Defaulting on a loan can have severe consequences, including damage to the business's credit profile and potential legal action from lenders. 16. Limited eligibility. Obtaining a business loan may not be feasible for all entrepreneurs. Lenders often have specific eligibility criteria related to credit scores, business performance, industry type, and other factors. Entrepreneurs who do not meet these criteria may find it challenging to secure a business loan, limiting their access to the capital needed for their business endeavors. 17. Inherent financial risk. Taking on a business loan inherently involves financial risk. Whether it is due to unforeseen market changes, business challenges, or external circumstances, there is always a level of uncertainty associated with borrowing funds. Entrepreneurs must carefully assess their risk tolerance and ability to handle potential financial risks before committing to a business loan. N.